And for more, I'm joined from LA by Sage Brennan. He's the CEO and co-founder of China Luxury Advisors. Sage, thank you for joining us.
Good to be with you.
Sage, as we've just discussed, Chinese luxury spending making up about 45% of the global market. So how big of a concern is the weaker RMB on global luxury brands?
Well, sure, and that's a great question. That's one that we'll be constantly looking at over the next 18 months as we see the sort of shakeout from this current sort of bloodbath in the last few days. I think it's been very interesting to watch continued spending this summer in particular, even as things start to soften in China. There's been no real let-up in terms of tourism spending in Los Angeles, Paris, New York, et cetera, in spite of some of the weakening. And I think the underlying message here is that China is still growing, even as things soften a bit. The middle class is growing very quickly, and affluence is really growing at a very rapid clip in China still today.
Well, Sage, you say that China's still growing, but some of the data points give us another signal. Prada had a 44% drop in profits in the second quarter of this year due to a decline in China sales. The group that owns Gucci and Alexander McQueen, that's the Kering Group, it had its sales drop 10% in Asia. So how do you think brands are going to adjust to this? Do you think they could revise their pricing?
I think in some cases they may need to, and we've seen some recent adjustments based on the global importance of Chinese consumers and not wanting them to be on a different sort of playing field. So we saw some of that with, I believe it was Chanel back a few months ago, and so on. So we may see that going forward, and I think that's more about adjusting to global pricing and making sure that Chinese consumers feel like they're getting global prices when they shop in China, which has not been the case for most brands. It's been a complicated picture with all the added overhead of investing in China, the uncertainty and the risk of the market as well. So I think over time we'll definitely see prices sort of marginalize and sort of adjust to global prices. But what we're seeing today is still a continuing growth in spending by tourists overseas. I would be very surprised if that goes down, because there's still a huge vacuum in China in terms of opportunity to buy global goods at global prices. So tourism especially is continuing.
Won't a weaker currency, especially when converted back into euros or the Japanese yen, which have been some of the hot spots for Chinese tourists, impact tourism and impact the shopping-driven tourist?
Short answer, yes. There's no question that it will impact. I think my sense is that given the overall growth of the luxury industry in China, some of the overinvestment that some brands have made, there's a little bit of rationalizing to happen clearly over the next 18 months with some of the huge brands, especially Richemont. Mont Blanc has over 100 doors in China now. They may have invested a little bit too quickly, and expectations clearly have come down to earth, so to speak. So I think we'll see some right sizing, if you will. Also, we're not entirely sure when the domestic market in terms of luxury will catch up with what's been happening here in Los Angeles and Paris and New York, where we've seen such massive growth in luxury spending.
Well, Sage, Swiss watchmakers have been particularly bad hit, especially with the Swiss franc so strong since it unpegged from the euro. But we had an interesting take from Swatch's CEO, Nick Hayek. He said that he was not concerned about the fall in value of the yuan because he said he saw it, quote, as a good sign that China wants to stimulate exports and wants people to work again and create more consumption, and that Swatch sees this measure as a positive and not a negative. What's your take?
Well, that's a way I consult brands on all the time, and large major corporations who are looking at China, whether that's market entry or trying to attract Chinese consumers. Really, this is a long-term play. Chinese investors and Chinese consumers look at the long term, and any company that goes in and expects to manage quarter to quarter a consumer business in China is crazy. It's not going to work. So really investing over the next 20 years, which is what some of these larger companies, particularly in the luxury sector, have done and have done so well. And I think that's the way to go. So he's right in that sense. I don't see us falling off a cliff. Certainly China is still growing very rapidly, and I think the market overall is very healthy, especially as China is making an effort to really support its own economy and build that consumer base.
Well, let's see if you agree with him on this one, Sage. Hayek also says that Swatch's company is seeing growth in India. Do you think India could be the next frontier for luxury brands? Which geographic markets are likely to see growth?
I'm looking at India very carefully, and I think I'm also looking at the companies that the countries that are very close to China and Greater China, whether that's Korea especially, which has seen so much growth in terms of tourism spending. Media in Korea is very popular in China, that sort of thing. India is a very different picture. We've seen a lot of growth in India. It's been sort of spiky and very clumpy in terms of being in urban areas. They have not seen the broad-based sort of economic growth that China has over the last 10 or 20 years. So it's an open question, and I think it's certainly an opportunity if you want to get into a market early to look at the luxury sector in India. We've seen so much growth in markets like Hong Kong, all of Southeast Asia, which are in the sort of China sphere. And I think it's up to India to see what kind of their own business they can develop, and in terms of, in the luxury industry, building their own sphere of influence.
All right, we're going to have to leave it there. Thank you so much. Sage Brennan, co-founder and CEO of China Luxury Advisors.